Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about seasonal trading strategy in the Forex market. You will learn how to identify and leverage recurring patterns that can give you an edge in the market. Stay tuned to discover how this time-based approach can enhance your trading toolkit, potentially improving your results. So let's get started. We first start by understanding what seasonality in forex trading refers to. These are recurring patterns or trends that certain currency pairs exhibit at specific time of the year. These patterns are not random but are grounded in history data and observable trends. As a trader, understanding seasonality can give you a significant edge in anticipating market movements and adjusting your strategies. So seasonal patterns in forex emerge due to various factors, and the factors are as follows: economic cycle, fiscal policy, holiday effect, and investors behaviour. It is crucial and important to note that the seasonality can be a valuable tool. It should not be solely based for your trading decision. Market condition can change on and can show unexpected events that can disrupt the pattern. So these patterns are solely based for trading decision. Let's not forget market behaviours can change and unexpected events can happen and disturb this pattern. So there are some common seasonal patterns in the forex which include the January effect. This is when the US dollar often experience an increased volatility in January due to the portfolio rebalancing and the start of a new financial year for many institutions. The second is the summer doldrums. From June to August, trading volume typically decreases due to the holiday season in many parts of the world. So let's look at the volume during our US pairs. The volume of our US based pairs on the daily time frame. The volume the volume during January is always to the upside. As you can see, this is January and we can see there is an increase in volume. Shows that the US typically rises during there should be an increase in volume during on USD pairs during January. This is called the January effect. While the summer down is trying to say from June to August, volume reduces in specific pairs. From June to August, this is what it means. From June to the August, we are going to experience a weaker point in the market where the volume reduces. From June, this is the month of June, to August, we can see the volume is being in a reduced form, showing that there will be a little bit of volatility in the market during this period in time. So let's see how we can implement the trading strategy to our day-to-day trading life. We have to first of all explore the three seasonal trading strategies that can give you an edge in the market, which are the Santa Claus rally, the sell in May and go away, and the turn of the new effect. I repeat, let us look at the three seasonal trading strategies that can give us an edge in the forex market, and they are as follows: the Santa Claus rally, the sell in May and go away, and the turn of the month effect. These are the strategies that we can use in implementing a seasonal trading strategies. So how do we start? We start by explaining the Santa Claus rally, and this refers to the tendency for stocks to rise during the last 5 days of December and the first 2 trading days of January. This phenomenon can impact forex markets such as pairs involving US dollar. So we are trying to say that during the last 5 days of December to the first 2 days of January, we are going to experience a rise in price. How do we enter using this strategy? We first of all open a long position against a basket of majority currencies at the close of the last trading day before the 5 days of December. So first of all, we look for the fifth day, the last fifth day of December, which is the 25th of December. The 25th of December should be cutting. Yes, this is the 25th of December candle, and there is no candle. We go to the 26th, showing that from this 26th to the 2nd of January, there should be a rise in price. All we need to do is enter a long position at that time in the market, and we close our position at the end of the second trading day of the new year. That is the 2nd of January. We enter our position and close on the 2nd of January. And as we can see, that would have been a profitable trade. The second thing we need to note while taking this Santa Claus rally is our risk management. Always set your stop loss at 1% below the entry point. You just need to set it at 1% below the entry point against any unexpected market movement. This is for the Santa Claus rally. Now we would enter the sell in May and go away. This strategy suggests that the market tends to underperform during May to August compared to November to April period. What you need to do, you open a sell position on the growth oriented pairs such as the New Zealand chair pair. We need to enter the position close to the last trading day of April. The last trading day of April is when you enter your position. We enter our position on the last trading day of April, which is on the 20. On this time, it was the 28th of April, because the 28th was the Friday. So we would enter on the 28th a selling position, and we will have to hold this position. When we would exit this position we'll exit this position on the last trading day of October. So this is possibly a positional trade on the last trading day of October, which is the 31st of October. Holding this position would grant us a significant profitable trade, because the market tend to underperform during this period in time on this particular growth oriented currency pair. Remember, risk management implementation of a trailing stop loss of 2% to protect the profit while allowing for some market fluctuation, meaning you will use a trailing stop. When price begin to move in your favor, you trail your stop loss accordingly, and so on and so forth. Now let's look at the last strategy, which is the turn of the month effect. The last strategy is the turn of the month effect, and this strategy capitalize on the tendency for positive return around the turn of the month. It is in various financial markets, which includes Forex. The entry is you open a long position on major currency pairs against the JPY, at the close of the fifth to last trading day of the month. The fifth to last trading day of the month, you open a long position, meaning on the 5th of October here, we would open a long position and you ride the long position until the last day of the month, which is the 30th of the month, and you can see that this position would have banked in a profitable trade. We have to exit or close our position on the 3rd day of the new month. So we can decide to close our position on the 3rd day of the new month, and as the case may be. Don't forget your risk management. You have to set your stop loss to at a 0.5 level below your entry point to account for the short term nature of this strategy. While this strategy has shown historical success, past performance doesn't guarantee future results. Always combine this approach with thorough market analysis and robust risk management for best chance to succeed in forex trading. So even if we know that markets usually tend to go to the upside or tend to trend in an up direction at this particular time, we are not guaranteed, because we also need to analyze the market direction at this particular on this particular pair or whatever pair you are trading this seasonal strategy on. Now let's look at some common mistakes we need to avoid and how to avoid them. While using the seasonal trading strategy, even if it is a powerful tool in our forex arsenal, they come with some of their own set of challenges. Now let's explore some of their common mistakes and their pitfalls, and how we can navigate around them to maximize your trading success. The first pitfall is over reliance on historical pattern. One of the biggest mistake forex traders make is assuming that past performance guarantee future results. Remember, markets are dynamic and constantly evolving, so you have to always adapt to when the market is ready to change and when the market is ready to change its hand. Always analyze the market context. The next mistake we need to avoid is ignoring risk management. Even with strong seasonal tendencies, the forex market can be unpredictable. Neglecting proper risk management can only lead to significant losses. So we need to incorporate a strong risk management rule while taking trade using seasonal tendencies. The last but not the least is failing to adapt to changing market condition. When market evolves and strategy that works in the past become a less efficient strategy over time, meaning when the market is evolving, strategies that work previously might not work over time. So to stay ahead of the market, you have to continuously educate yourself about the new trading technique and market dynamics. Secondly, you need to regularly review and adjust your seasonal strategy based on their performance. The third rule is to prepare to abandon or modify any strategy if the market condition changes significantly. So we need to avoid this set of mistakes when trading the seasonal tendency. The last one is overlooking transaction costs. High trading frequency can eat into your profit through spread and commissions. Be aware of this po ten tial pitfall and implement the strategies to avoid them. Meaning that because we leave our trade for over days, over a long time, we might end up paying so much on swap fees or commission costs. So we need to trade in such a way that we can accommodate our position size to count for these negative swap fees or our commission costs. So you need to enhance yourself by implementing these strategies and avoiding the common pitfalls. to enhance the effectiveness of your seasonal trading approach in the market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.